All right, let's do something really cool today. We're going to build a trading bot from scratch. We'll start with just one simple human idea, and step by step, we'll turn it into a piece of code that's designed to navigate the market all by itself.
This is the billion-dollar question, isn't it? Can a simple, repeatable rule that you program into a computer actually outperform human intuition over the long haul? To figure that out, we really need to understand the journey from a basic concept to a fully automated strategy that's firing off trades in the blink of an eye.
At its heart, this is all we're really doing. We're taking a human belief, a gut feeling about how the market works, and we're turning it into a very strict set of instructions. The whole goal is to create a digital trader that never gets tired, never panics, and follows the rules with perfect discipline 24/7.
And this right here, this is the fundamental playbook for algorithmic trading. It's a loop. You have an idea, you code it, you test it against history, then you find its weaknesses and you try to make it better. You optimize it, and you test it again. Only after going through this whole rigorous process does an algorithm ever get to touch real money. Okay, so let's get our hands dirty and actually build one of these bots. Every single trading algorithm starts not with some crazy complex code, but with a simple observation, a hypothesis about how the market behaves that we can actually measure and test.
So here's our core idea, and it feels pretty intuitive, right? It's a classic trend-following strategy. But here's the problem. A computer has no idea what recent average means. It's way too vague. We need to translate this human intuition into a precise mathematical definition it can understand.
And here is the tool for the job. The 20-day moving average acts like a filter. By averaging out the last month of prices, it smooths out all that chaotic day-to-day noise and gives our bot one single clear line that represents the underlying trend.
And that's it. This is the entire brain of our bot in a nutshell. It's pure, simple binary logic. Is the price above the line or is it below the line? There's no fear, there's no greed. Just a simple and powerful if this, then that command.
All right, now for the moment of truth, the most important step. A clever idea is completely worthless until you've tested it against reality. We need to take our rule and see if it would have actually made money in the real world, using real historical data.
So this process is called backtesting. We're basically putting our new bot into a time machine and letting it trade over the last 3 years of market data. This simulation is going to show us exactly where our simple rule shines and, more importantly, where it fails.
And the results are in. Our backtest reveals a really critical flaw. It's like our bot has a split personality. When the market has a clear direction, up or down, our little trend-following bot does beautifully. But in a choppy sideways market, it gets totally whipsawed. It ends up buying high and selling low over and over, just bleeding money on false signals.
Now this is where our real algorithm developer earns their paycheck. The first idea almost never works perfectly. Now that we've found the weakness, our job is to program a solution. It's time to make the bot smarter.
So here's our fix. We're going to add a filter based on trading volume. The new theory is simple. A price move is a lot more meaningful if it's backed by a surge in activity. High volume suggests conviction. So we'll program the bot to only act on signals that have that conviction behind them.
And the result is a huge improvement. We rerun the backtest, and this simple volume filter allows the bot to just ignore a lot of that market noise we saw in those choppy periods. By being more selective, its performance becomes far more consistent.
Okay, so we've just built and refined our bot. In that process, we've actually been using some key industry terms. So let's put some official names to the concepts we've just seen in action. Getting this vocabulary down is crucial to understanding this whole world.
First up is the signal. The signal is just the trigger. It's the specific event that tells the bot, okay, time to act. For the bot we just built, the signal was the price crossing over that moving average line. For a different bot, it might be a news headline or a spike in Twitter mentions. It's the go command.
Next is slippage, and this is one of those harsh realities of live trading. In the time it takes for your buy order to travel from your computer to the exchange, the price can tick against you. Even a fraction of a penny's difference, when you multiply that over thousands of trades, can seriously eat into your profits.
And then there's latency. Think of this as the ultimate measure of speed. It's that tiny delay measured in milliseconds between your bot making a decision and the market confirming that the trade actually happened. For most of us, it's no big deal. But in the world of high-frequency trading, where firms spend millions just to shave off microseconds, It is the entire game. And what's really important to see is how the priority of these things changes. For our slow, trend-following bot, the quality of the signal is everything. That's all that matters. But for a high-frequency trading bot that's making thousands of trades a second, the only thing that really matters is minimizing latency.
So we've seen how a pretty simple rule can be tested, refined, and optimized into a genuinely powerful trading bot. It really leaves you with a fascinating question for the future, doesn't it? If algorithms are designed to find and exploit every tiny pattern in the market, what happens to the market itself when it's mostly just algorithms trading with other algorithms?